All right, teammates. So what we're going to do, we're going to go ahead and get started with week 2 of our life insurance boot camp training. I'm fired up and excited about it. And this is going to be one that I want you to, somewhat participate in, take some notes, and I'll share some details about, life insurance and life insurance policies that some of you may know, but a lot of you probably don't know, right? And there's a lot of information out there about life insurance and the different types of products and stuff like that, and what's right, what's not right. And so I want to settle some of that stuff once and for all for you tonight. And I can't do it all in tonight's training. I'll revisit some things next week. I'll even run some scenarios and stuff like that, some real life scenarios to show you guys just the power of what we've been able to do, and you'll be able to see just what you have your hands on here. I know sometimes we can kind of minimize it a little bit, Mike. We say, "Oh, we got this life insurance license." We can offer people life insurance that don't have it. Well, what I want to talk to you about tonight, Selena, is what if you run across somebody that already does have life insurance, but they have the wrong kind, right? And now I know, look, and I don't want y'all to just take my word for it. Well, you can, that's fine. But in order for you to be a true crusader, you need to find these things out for yourself. That's what Art Williams did, the founder of our company. When he ran into his relative at the family reunion down in Florida, Ted Harrison, he told him about buy term and invest the difference. Art said, man, it almost sounded too good to be true. How can there be that much of a difference between two different life insurance programs? He said that when he got home, he went to the library and he researched it himself. And he found out that it was real, and that the industry had been doing what they've been doing for a long time. So let me share my screen with you guys. All right. Give me a thumbs up if you can see my screen. All right, perfect. All right. So this is week 2 of our life insurance boot camp. What we're going to cover today is just the history of cash value life insurance, or what I like to call, you'll see it show up. We call it trash value life insurance. So just kind of roll with me on that. We're going to talk about breaking down whole life insurance. Now, whole life insurance is a particular type of cash value life insurance. There's other ones that are in there. You'll see some of those names here on the next screen. And then we're going to look at whole life versus buy term and invest the difference. We'll look at an example of that, right? And so let's check this out. Man, guys, there's an age-old debate when it comes to the life insurance space. This is the great life insurance debate. Which life insurance strategy is the best? So there's been a lot of people on social media, and there's been a huge uptick and a resurgence of folks that are talking about cash value life insurance products. And they go by various names. They go by whole life, they go by universal life, variable universal life. But the most popular version of the cash value life insurance product, Coach B Walk, is index universal life. Coach B Walk, you agree with me on that? You might hear them called IULs, right? I mean, that's the most popular version that if you do come across a policy, I dare say that the main 2 policies you're going to come across, Sean, is either a whole life policy or an index universal life policy. Those are going to be the 2, right? And so those are going to primarily be the 2 that we deal with. Now, we can deal with group life and all the type of stuff where people have through their job and all of that. But the main ones, personal life insurance, is whole life or index universal life. That's it. You have that side. You have that side. And then the other side is level term, right? And our level terms come in different year increments. You have a 10-year term. We talked about it last week when we talked about our different products. We have a 10-year term. We can do a 15-year term. We can do a 20-year term, 25-year, 30-year, and 35-year level term, right? We can do that. Now, here's the interesting thing is that your term is all going to be based on your age, and not all terms are created equal and all that good stuff. But this is our product right here. We do term life insurance. So Which one is the best version? So let's talk about, before I can kind of really dissect that, I want to set the table a little bit, teammates. Just hang with me here. Hang with me. And if you want to take screenshots, of course you can. But I want to set the table and talk about a book that I have. It's right here. I got a lot of books and stuff like that, but I got some books in here. A book that I have right here on my shelf. It's called The Mortality Merchants. And when I train on life insurance in this way, y'all have heard me mention this book and stuff like that. But when you read this book, it talks about the legalized racket, April, of life insurance and what you can do about it. This is an old book. This is not a new book. This book has been around for a long time, right? And so this just goes to show you that, man, what I'm telling you and what you might be seeing out there when people talking about universal life, index universal whole life, man, that stuff has been happening and been done to our communities for a long time, for years, right? But and now what I did, I took a story out of the book and I made it a little bit more contemporary to kind of suit our group, right? And they tell this story in the book, The Mortality Merchants. The story, they call it the tale of two families, the story of two families. Check this out, guys. This is a situation that happened, right? You see these two families, beautiful families, right? Husband, wife, daughters, all that stuff. But tragedy has struck both of these families. I mean, something unthinkable and unfathomable has happened, right? So this is what happened. On February 14th, Valentine's Day of 2025, Anthony, a 29-year-old teacher, husband, and father of one daughter, he was laid to rest. They had his funeral at a cemetery just outside of Chicago, Illinois, right? Man, another brother, he maybe it was a car accident, maybe it was an illness. We don't know. But he passed away. And I'm telling you right now, he wasn't by himself, because on the same day, there was another brother, William, a 29-year-old engineer, husband, father of one daughter also, was also funeralized at a cemetery just outside of Houston, Texas, right? Two brothers, same age, same family structure, wife and a daughter, were laid to rest on the same day. And y'all know what happens when people pass away. You have the funeral, you have the repast and everything like that. And there's a lot of support, there's a lot of love, there's a lot of tears, right? There's a lot of that. But there's also some sidebar conversations that's going on, right? Because if Anthony was a breadwinner, or if William was a breadwinner, then it just don't stop at the funeral. Y'all with me on that? See, there's some other things that's going on. And at some point, somebody is going to make a comment similar to the ones that I'm about to show you right now. At some point, they might not say it out loud. They might say it to one other person. They might say it to themselves. But at some point, somebody going to make a comment like the one I'm about to show you. Man, did Anthony have life insurance? Because Tammy and the baby girl, man, they sure going to need it. Am I right or am I right? Somebody's going to say that, or they're going to think that, or they're going to have a sidebar conversation about that. And then when it comes to the other couple, man, did Will have life insurance? Man, it's going to be rough on Keisha and the baby if he didn't. At some point, it's going to happen. At some point, somebody's going to say it, somebody's going to bring it up, but they definitely going to think it, right? Well, I'm here to tell you, teammates, that they both had life insurance. In this scenario that I'm showing you, these brothers had policies on themselves outside of their jobs, right? Let's talk about them. Anthony, he had a $175,000 policy on him. Will, he had $1 million policy on him. Are y'all with me? One person had 175,000, Anthony. William had $1 million policy on him. And so we can all understand the impact that these policies will have on their family, but one will have a bigger impact. Let's dig a little bit deeper on this. I'm going somewhere with this. Follow me, right? So this is the backstory. Anthony's got 175,000, William's got $1 million. This is the backstory. They both took out policies at age 27. They both got their policies, this is crazy, the same month. Check this out, Selena. They both have the same identical level of health. They got decent health, no health challenges or nothing like that, Coach B-Walk. But here's the kicker. They both paid the same monthly premium, $148 a month. Whoa, wait a minute, Nick, what are you talking about? Yeah. Took out the policy, same age, same month, same level of health, and they were both paying $148. Anthony was paying $148 for 175,000. William was paying $148 for $1 million in coverage. You might be asking yourself, what am I missing? What are you talking about? Well, it just all breaks down to who was sold what. See, Anthony was sold a whole life policy. William was sold a level term policy. I'm going to repeat that. Anthony was sold a whole life policy. No, he didn't buy it. He was sold. There's a difference. He was sold, Sean, a whole life policy. William was sold a level term policy. And this right here, ladies and gentlemen, is the challenge and the robbery that has been committed intentionally in our communities for decades. Because at the end of the day, when you look at these two families, the person who sold Anthony the $175,000 in coverage, Coach B-Walk, they could have sold him the $1 million in turn. But they didn't. They sold him the 175, April. That's what they did. And so this is what goes on. This is straight out the book. See, one company, one insurance company paid a death claim of $1 million, while the other company paid only $175,000, but both companies could afford to pay the $1 million. That is an $825,000 discrepancy. Money that is not going to go to Anthony's wife and child because somebody chose to sell him the $175,000. Somebody chose to sell your best friend, your coworker, your church member, your brother, your sister, your family member, the whole life policy and not the term. And because of that, there's a discrepancy in the coverage amount that they should have had. Nobody didn't think that tragedy would strike like this, but it did. And it left a $825,000 shortfall in this family's financial situation. Now, I want you to do this. Check this out. I want you to multiply that discrepancy by the millions of policies that are sold, that have been sold over the past century. And it adds up to an unimaginable amount of money that the life insurance industry will never have to pay out because they've intentionally sold people the wrong product, had them overpaying for it, and therefore they're underinsured. And so when y'all hear me say things like, have y'all heard me say things, and this is for my team, have you heard me say things that, people have been intentionally sold the wrong type of life insurance? What do I mean by that? They're paying too much money, they're getting too little value, and they don't even know it, guys. That ain't a made-up thing, that's a real thing. And so when you look at people that have certain types of policies, they didn't know nothing about life insurance. They were at the mercy of whoever the agent was that sold it to them. Am I right or am I right? They didn't know, but that's what was sold to them. So check this out. This is an article from CNN Money. If you try to look for this article, it's going to be hard to find, but I got a screenshot of it. It's from 2017. This is from CNN Money. It says life insurance. Y'all check this out. Choosing a life insurance policy. The article reads, look at this, Coach B-White. It says, life insurance is a highly competitive business in which the sales force depends almost entirely on commissions. Insurance companies pay fat commissions for selling whole life policies. Perhaps 80% of your first year's premium goes to who? The agent. Commissions, I'm reading it straight off the page. Commissions for selling term policies amount to roughly the same percentage of the first year's premium. But since whole life premiums are much higher than premiums for term life policies with the same death benefit, they can be 5 to 10 times more. Agents make more money selling whole life policies than they do selling term. Let me go back and highlight something. 80% of the first year's premium goes to the agent. Agents make more money selling whole life policies than they do selling term. It's no wonder then that agents push whole life policies as if their livelihood depends on them. But the fact is, the vast majority of those who need life insurance should buy what? Term. This is not a Primerica article. This is a CNN Money article from 2017. And so if you ask yourself the question, why would a person sell the whole life policy over the term life policy when they can get the family more cover? I just showed it to you. Because whole life agents, they ain't worried about what's best for the client. When that person sold Anthony that policy, he wasn't worried about Anthony's family. He was worried about the fat commission that he was going to make. And we'll get to more of that later. Now, this is a more diabolical article right here. This article is from the Philadelphia Inquirer. It says, paying a premium. It's no longer legal for life insurance companies to calculate rates using race. That hasn't ended a two-tier system. Guys, this article was from November 2022. You can Google this article and find it. And this is just an excerpt from it. Check this out, Sean. It says, today, African Americans are more likely than their white counterparts to look to life insurance to cover their final expenses. Yet, white families have significantly larger policies than their Black counterparts, even when income levels are the same. Patricia Wheatley, this is not a fake person, this is a real person. Patricia Wheatley was surprised last spring when her mother, Sylvia Franklin, unexpectedly died of COVID-19, and Wheatley discovered her mother's insurance policy didn't extend much beyond covering her final expenses. What? Oh, but it gets crazier. It says Whitley described her mother as a brilliant woman who had several degrees in social work. So she was an educated woman. But education doesn't necessarily translate into financial literacy. Does that make sense? That's where we come in. She was one of the first on the front line of the HIV/AIDS epidemic in the early 1980s, refusing to shun patients. Yet the two never spoke of her finances, and her mother didn't talk much about money in general. Sound familiar to anybody? It turned out her mother's policies was a type of whole life insurance disproportionately, I'm not making this up, disproportionately marketed to African Americans. This article came out in 2022. So let's talk about how a whole life policy works. Now, read that article. Go and read that article. Let me check it. Paying a premium. Philip, read the whole article. It'll blow your mind, guys. It'll blow your mind. Read that whole article. All right. So how does a whole life policy works? Well, how does it work? How does a whole life policy work? Let's talk about it. All right. So let's just say that a person has a whole life policy, and they got $175,000 in coverage, and their monthly premium, Sean, is $148 a month. Is everybody with me? Give me a thumbs up if you're with me. You with me? All right, perfect. All right. So this is how the policy works, Sharice. So that $148 that they pay in that premium every single month, part of that premium, that $140, not all of it, goes to pay for the cost of the life insurance. Because this is a bundled product. It has a life insurance component and a savings component, Sade, bundled together. Part of the $148 a month premium goes to pay for the life insurance. The cost of the life insurance stays the same for the life of the policy. But then another portion goes into a savings account. This is a separate account, right? And this is where people say, hey, my policy is building cash value, right? That's what it's saying. So $148 a month, $175,000 in coverage. Part goes to pay for insurance. The other part goes into the savings. What most people don't know, Selena, is that the savings portion of a whole life policy, check this out, this is important. The savings portion of a whole life policy is designed to be approximately 50% of the face amount when the client turns age 65. The amount that's in that savings, the way that they price the premium out, is designed for that savings account balance to be approximately 50% of the face amount of the coverage by the time the client turns age 65. So what's 50% of that 175, right? You get that number. That's what's going to be in this client. If they don't borrow against it or anything like that, it's designed to be that. What is that? $87,500 is supposed to be in the policy by the time the client turns age 65. That's how it works. And on the surface, it sounds good. It does sound good. Wait a minute, I get the best of both worlds. I can get coverage, I can get a savings, I can get all of that. Man, sign me up, right? And check this out. This is what they also tell you. Hey, man, you can use that savings as an emergency fund. You can use that money to pay for your kids' college education. It could be a supplemental retirement account. It could be a side investment. You can use the money to even start a business, et cetera, et cetera. This is how they're saying it. These are some other ways. This part right here, there's some other ways that the agent who's selling the whole life policy, these are the things that they may say to sell the policy. Hey, this is a permanent life insurance policy. Just like the name says, this policy will give you life insurance for your whole life, right? Your monthly premium, Mr. and Mrs. Client, it stays the same. So you'll never have to worry about your premium payments going up. Hey, every time you pay a premium, Selena, it's like you're building equity in your policy. Just like every time a person pays their mortgage, they're building equity in their home. This is what they're saying. And when they're saying this to people, it sounds good. What about this one? This policy, Mr. and Mrs. Klein, it builds cash value. The cash value works like a savings, Sharice. You can use the money for emergency, kids, college education, retirement, start a business. Do you know that how Walt Disney started Disneyland? He had a whole life policy and he used, these are lies, but they say that. Did you know that Master P started No Limit Records from a home? This type of policy that wealthy people have been using for years to get ahead. This is an untold secret that wealthy people have been using and leveraging cash value policies like whole life policies in order to be able to create wealth. And then with this policy, you can be your own bank, meaning that you can borrow the money from yourself. You can be your own bank. These are things that agents out there are selling, are saying to sell these policies. And then look, term policies don't have any benefits. It's like owning a Hyundai versus a Bentley, with the term policy being the Hyundai and the whole life policy being the Bentley. These are the things that are being said to sell these policies. And then last but not least, teammates, drum roll, please. This is the last one. The last bit. Oh, the money in the cash value is tax-free. You get the money tax-free, guys. Oh, fireworks, there's a celebration. And the crowd goes wild. And your best friend, your auntie, your cousin, your co-worker all got these damn policies because this is what they were told. And they didn't know no better. They don't get no life insurance. They don't know. They don't know. So it sounded good. Hell, I got insurance. Hey, man, I can borrow my money. I can be my own bank. I'm getting I'm what the Rockefellers did. Yes. And then this tax-free thing. But it's really tax-free. See, let me ask y'all something. Has anybody ever got an income tax refund? Raise your hand if you've ever got an income tax refund at any point in your life. April, like just a little one, right? Let me ask you something. Did you have to pay taxes on your income tax refund? Did you have to pay taxes on that money? No. You know why? Because that was your money. So the reason why a lot of times you ain't got to pay taxes on the cash value is because that's money that you put in. So why are you paying taxes on money that you've already been taxed on? That's your money. So the same way you don't pay taxes on an income tax refund, you're not going to pay taxes on money that's in a life insurance policy. Does that? I'll carry on. So this is an illustration I like to use, and I'm driving this home. And how a life insurance, a whole life policy really works. I want you to think about where you bank. Who's your bank? Sharice, who your bank? You know, somebody do this example with me, right? Somebody do this example with me. Somebody come off mute. Who want to volunteer to do this with me, right? Anybody? Who wants to be my volunteer? Just work with me. You ain't got to do much. Okay, April, you'll do the deal with me. Okay, gotcha. Thank you, sis. All right. So I'm gonna share my screen, and April, we're gonna work through this. All right. So April, let's just say that. Where do you bank at right now? Name a bank. Who do you bank with?
I can't see your screen. I only see Selena.
Okay. All right. I'm sharing it right now.
Okay. I'm sorry. Okay. I bank with Chase.
Okay.
And USAA.
Okay. This is a good example. I bank with Chase, right? Let's just say that April, you went into Chase and they had a new account that they wanted to tell you about, right? You've been a faithful customer, loyal customer of theirs for years. They said, hey, listen, you know, we have this new type of account, Miss Sunanan, and we want to tell you about it. But I want you to listen to all the features before you make your decision. And then we want to know if you want to open up this type of account. Now, this is how it works. These are the new bank account features. And I want you to ask yourself, and I'll ask you this question at the end of each feature that I tell you. Do you think this feature benefits you or if it benefits the bank?
Okay.
You with me? Does it benefit you or does it benefit the bank? Okay, this is the first feature. For the first 2 to 4 years that you faithfully make deposits into this bank account, you're still going to show a zero balance. And if you're wondering where the money went that you were depositing faithfully every single month for the first 2 to 4 years, the money went into my account because I'm the banker that opened up the account for you. So it went as part of my commission, part of my compensation. So for the first 2 to 4 years, if you check your balance on the account, it's still going to show zero, even though you've been putting money into it every single month. Do you like that feature?
Absolutely not.
Right. So who does that benefit? Does that benefit you or does that benefit the bank?
I don't even know if it benefits the bank. It benefits whoever's selling it. It's going into your personal account or the bank.
Right. So it doesn't benefit you.
No, it doesn't.
All right. So let's see if we can get past that. Let's just say that you can get over that and you open up this account and you get past that 2 to 4 years. Once you do start showing a balance account, if you want to take a withdrawal, you cannot do a withdrawal out of this type of account. You can just do a loan, which means that whatever money you have in this bank account, you have to borrow it and you have to pay Chase back 6 to 8% interest on the money that you borrow from your account. And that 6 to 8% does not get credited back to your account. It actually goes to Chase in their bottom line.
They selling crazy at this bank.
Yeah. So you don't like that feature either. I take it by you saying, okay. Because who does that benefit? Does that benefit you or that benefit the bank?
The bank.
Absolutely. All right. So another one. Your money grows in the account at about 2 to 4% rate of return. Now, if you take money out, it's a loan. They're going to charge you 6 to 8, but it's only going to grow at about a 2 to 4% rate of return, right? But here's the kicker. April, you know how sometimes people can fight over money when folks die and they pass away, right? I've seen it happen in my family and other families as well. Well, guess what? You don't have to worry about that with this type of account, because if you have money in this account, when you die, Chase just gonna keep the money that's in the account.
You don't have to worry about anybody arguing over it.
No, because Chase just gonna keep it. So whatever balance you got in this account, they're not gonna get it. Chase is gonna keep that money. And so my question to you is, would you like to open this account?
No.
No.
This is an example.
Yeah.
About whole life insurance. It was not explained to me this way when I bought it.
Because if it was explained to you like that and anybody else who bought it, you wouldn't have bought it. Right. But this is exactly how a whole life policy works. This is it. Because teammates, check this out. When you buy a whole life policy, these are the cash value fee, the features of the cash value. For the first 2 to 4 years that you have a whole life policy, you are faithfully paying that premium every single month. You're going to show a zero balance in the cash value, because the money that you're paying in the premium, that's part of the residual commission that the agent gets paid. Now, the company, the life insurance company, they get some of it too, but the agent gets paid that. This is why they sell these types of policies, guys. And then once you do show a cash value, when you go to try to take money out, you borrow it. Have you ever heard somebody say, hey, I'm borrowing against my life insurance policy, right? And I'm thinking to myself, and as you should too, now that you're aware, why do you want to borrow against your policy? That's your money. That's not something that you should want to do. Yeah, don't borrow against your policy. You should be able to withdraw your policy from your money from your policy. Your money only grows at about 2 to 4% rate of return. But then here's the kicker. When a person dies that has a cash value policy, the insurance company keeps the money that's in the whole life policy. They keep the money that's in the savings, because family, they only consider it a living benefit, not a death benefit. That's the key language.
That definitely wasn't explained to me. I thought that they would get the death benefit and the cash value. I really did think that.
No.
Yeah. Mm-hmm.
Was anybody else like April to where you thought that whole life policies work different? Yeah.
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 So what's supposed to be the death benefit then when somebody died with the whole life?
The death benefit is the face amount of the policy. But the face amount and the death benefit does not include the savings in a whole life policy. It does not include.
I have one more question. What would you think are the advantages of the term for 20 years? For instance, somebody at the age of 50 taking a term of 20 or 25, if that's possible, and the person is sick. For instance, I would think if you have whole life and your parent has dementia at 72, they would maybe get some of that money. Whereas with a term, do they get some money or they have to die for the beneficiary to get that income?
That is a great question. And to answer your question, the solution would be not just term insurance, but to do by term and invest the difference. And I'll show an example of what I'm talking about here a little bit later on down the line. Because term life insurance by itself, it's not enough. I mean, it's half the job, right? We do need to pair an investment account to go along with it, so we can be able to take care of the financial needs of a client later, right? And so that's the important piece. And I think that that's what you're talking about, Miss Virginia, in terms of what if a person needs some money a little bit later? We have the solution for that in the approach that we take. It's by term and invest the difference. And so let me show this. So this is an actual whole life policy, right? Client's name has been redacted, all that stuff, but these are pages from a whole life policy. Give me a thumbs up if you guys can see this. Okay, all right. So I'm gonna just circle a couple of things. So this policy was issued in March of 1993. The client was 28 years old when they got this policy. And it says right here what type of plan it is. Hey, it's a whole life plan, right? Can y'all see how much coverage they have? They have $150,000 in coverage, right? That's their coverage. And their monthly premium is $121.28 a month. That's what they're paying for this. 28 years old, $150,000 in whole life coverage, $121.28 a month. Now, the next thing I want to point out, and check this out, Miss Virginia. This is the cash value accumulation table that is inside of the whole life policy. It shows you basically what the guaranteed cash value is going to be over the years in this policy. Now, I'll be honest with you, teammates, a lot of companies now, they don't really put this table in some of these policies anymore because it's too much transparency, right? But there are some out there that they still have them in there. You might have to dig for it, but it's in there. Do y'all notice when you look at the guaranteed cash value, how much cash value do they have after the first year? 0. How much do they have after the second year? 0. How much money do they have in the cash value after the third year? $150. Wait a minute. They have $150 in the cash value after 3 years of paying $121.28 a month, Sean. They've paid a total premium, look at this, teammates, of $4,366.08, and they got a whopping $150 in their cash value to show for it. Come on, somebody. And then let's scurry on right? To age 65. What's the cash value supposed to be at age 65? Isn't that 50% of, see, y'all thought I was playing. The cash value at age 65 is designed in whole life policy to be roughly around 50% of the face amount. And that's exactly what it's showing. And then there's something else I want to show you. The guaranteed interest rate for this policy, they say, hey, man, we're going to give you 4%. The rate of return we're going to give you is 4%, guaranteed interest rate. But I'm not done with this policy. Let's keep going. These are some other pages from this policy. Let's look at the policy loan section of this policy. Check this out. What does this say? It says you can get your cash from this policy. No, you can get cash from us by taking from us. That's my money. Why you talking about my money like it's your money? You can get cash from us by taking a policy loan. Who put the money in there, y'all? Did the insurance company put the money in there? Did you put the money in there? Last I checked, you put the money in there. But they talking about you can get the cash from us by taking a policy loan. Check this out. The loan interest is charged daily at a rate that we set from time to time. What if you took out your mortgage and your mortgage company put this language on your loan? Hey, your loan, your mortgage interest rate, Sean, is charged daily at a rate that we set from time to time. What does that mean? What is this? The rate of interest we set for the policy year may not be more than or higher of the published monthly average for the calendar month ending 2 months before the start of the policy year, the rate we use to compute the guaranteed cash value of this policy. Huh? What? I'm so confused. I'm like, and they sleep like that for a reason, y'all. This is by no accident, guys. This is what's being sold intentionally to our people. This right here. This is it. I'm telling y'all. I ain't done yet. Payment when the insured dies. Oh Lord, hold on a second. Let me stop it real quick. Guys, we got to do out here. What I'm about to show you all right now goes against it's people who sell whole life that don't even know this. They just out here slanging the insurance, don't even know what they selling. They have no clue what they selling until I show up, and I'll show them in their own policies what the language is in their policies, April, and they act like it's a revelation to them. Because they'll sit up and argue me down that they don't know the client, they get the cash value in my policy, blah, blah, blah. Break the policy out. Let's look at it together. If it's a whole life policy, let's look at it. Check this out. Are y'all ready for this? Look at this. Payment when the insured dies. I'm not making this up. When the insured dies, the amount of money called the insurance proceeds will be payable, Sean, to the beneficiary. The insurance proceeds are a total of the face amount of the insurance, plus any insurance on the insurer's life that may be provided by riders, bought by dividends, left of interest, and all that type of stuff, blah, 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 minus any policy loans that you've taken out. Oh, yeah, they taking that out. If you took a loan against the policy, they deducting that from the death benefit. And any premiums due. Let me ask y'all a question. Does it say anything about this person getting the beneficiary getting the cash value? Of course it doesn't. And the policy only pays what's in black and white. So I tell people all the time, clients that try to argue me down, April, I don't give a damn what your agent told you. The agent ain't going to be able to pay out. Like, this is what your policy is going to pay out. And it says it right here in black and white. you're not going to get the cash. Your beneficiaries will not get the cash value because that's a living benefit, not a death benefit. You only have access to that money while you're alive. If you die and you have money in that cash value, I'm telling you right now, they're not getting it. Omar, talk to us, brother.
Hey man, great train. Can you hear me?
Yep, we can hear you.
I just wanted to follow up and add to the cash value table, if you don't mind putting that up real quick.
Yep.
Because they still have one more chance to rip the client off. So what that means on those three tables, as you're saying, right, it doesn't grow for X amount of years and whatnot, right? But let's say, I'm going to role play with you, Nick. Let's look at year 2003, 12,000 in the cash value, right?
Yep.
Let's say you want to cash out, right? So these are the three options they give you. One, cash out, Nick. You get 12,000, right? Minus
Right.
surrender, but let's forget about that. But you know what, Nick? If you take the money out, you're going to be left with no insurance, right? And you're going to lose everything you paid into it. Which, what have they done for you? Nothing, just take your premium. But anyways, why don't you instead use the next option, which is reduce paid up, right? Next column. So they're going to keep 12,000 and they're going to give you a whole life policy with $42,000 worth of death benefit paid for until age 100. So they keep you 12,000. They give you a new mini whole life with 42,600 in coverage that you don't have to pay premiums for until age 100. But if you don't like that option, Nick, don't worry. Forget about that option. We're going to give you a term policy if you keep going to the right. In this case, we're still going to keep you 12,000. But we're going to give you a term policy that is going to last 17 years, 68 days, and then we're going to extend the original coverage of 150,000. See what I'm saying? So they're telling you, how do you want us to keep your cash, Nick? Because we want to keep your cash, right? We already know that. They want to keep your cash. You want us to give you a mini whole life, which is reduced paid up, or you want to get a term policy for 17 years with the original coverage? How do you want us to keep your cash?
Wow. So they want you to pay for two things. They convince you're paying for two things, but the way they design it is that you only gonna get one. You're paying for two things, but you're only gonna get one. That's it. Thank you for that, Omar. That's fire, bro. Last thing before I just kind of wrap up this portion of it, let's talk about the cash value. The policy has cash value while the insured is what? What does that say, Sean? Alive. Alive. There are several ways you can use all or part of the cash value. Take a policy. Now, keep in mind, this is your money. It says take a policy loan from us. That's one. Two, take the cash value of any insurance bought with dividends. Take the dividends left to us to earn interest, surrender the policy to us for its full cash value. But that's the one that just gets me, y'all. Take a policy loan from us. They treat your money like it's their money. So, Miss Virginia, this is the example that I wanted to show you, right? And so the question becomes, which program would you buy? This is a whole life policy versus buy term and invest the difference. So check this out, teammates. This is a whole life policy. The person who got the whole life policy, this is John. He's a standard non-tobacco rated client, right? He has $150,000 in coverage. He's 28 years old. He's paying $121 a month, basically the same policy that we just showed, right? By age 65, he'll have approximately $75,000 in the cash value. Now, here's the thing. If John dies, if he dies, his family is going to get a choice of whether or not, let's say he died at age 65, his family will get a choice of, do you want the 150,000 or do you want the money that's in the cash value? They're going to take the 150,000 and whatever's in that cash value, they're going to lose it. Is everybody with me on that? Give me a thumbs up if you're with me. All right. For that same $121 a month, Coach B. Walk, John can get $300,000 in coverage through Primerica, double the coverage for only $53 a month. Look at this, y'all, for only $53 a month, right? Now, if you do the math, there's a difference between $121 and $53. That difference is $68. If John took that $68 difference, teammates, and invested it and got an average 9% rate of return, right? In 35 years, when he's age 63, he'll have a whopping $201,542. And if along the way he dies, his family gets both. They get the money that's for the insurance and they get the money that's in the investment. They get both. They don't have to choose between one or the other. They get both. Let me ask y'all a question. Put in the chat. If you had your choice, if somebody offered these two programs to you, which one you doing? You doing whole life or you doing buy term and investing? Which program would you buy? Put it in the chat. You like the left side or you like the right side? You can make it easy like that. Left side or the right side? I feel the right side is the right side 100% of the time. 100% of the time. And with the market that we serve, guys, our target market, people that are between age 25 and 55, all that stuff, buy term and invest the difference beats whole life every single time, hands down. We give people more value for the money that they're spending every single time. Every single time. And so these are the three nevers when it comes to buying life insurance. Always remember these. Number one, never buy any kind of cash value or whole life insurance, including universal life. Never buy any kind of life insurance like that, right? Don't do it. Number two, never buy life insurance as an investment, right? Life insurance is the worst investment. Don't ever do it. You're not gonna get more than what you put in. It ain't even designed for that. I can get deeper into that, but yeah, just never buy life insurance as an investment. Even though it might be sold to you or trying to be sold to you as an investment, never buy life insurance as an investment. You can do better. And then number three, this is a big one. Never rely solely on life insurance provided by your employer. And so this is a water cooler conversation right here, guys. When you're at the job and people are talking and stuff like that, or you at the family reunion, or you at brunch with your friends and stuff like that, and you know the subject comes up about what you're doing and you got a license and stuff like that, and they say, you know, man, how do you do that? What do you know about that? What do you know about that? Well, one thing I've learned is that there's three nevers when it comes to life insurance. And people are going to lean in and say, three nevers? What are the nevers when it comes to life insurance? For number one, you never buy any kind of a cash value life insurance product. And those are whole life, universal life, stole your life. Yeah, throw that one in there. Stole your life. Never buy any kind of product, life insurance product like that, because they're not good for you. That's number one. Number two is you never buy life insurance as an investment. Never buy life insurance as an investment, meaning that you're going to put money in to try to get a return. Now, if people want to buy life insurance as a means of creating generational wealth and leaving a legacy behind for the family, that's different. I'm talking about people saying, I'm going to take my 401k balance because somebody has talked me into it. I'm going to take a lump sum loan from my 401k and I'm going to dump it into this index universal life policy. I'm going to take $200,000 loan against, y'all do know that people are getting talked into this. I sold my house. I made a profit from it. I'm going to put this $120,000 from the sale of my house. This jackleg then came over here and talked me into dumping this this money into an IUL, and I'm about to be rich. No, the only person that's getting rich is the dude that sold it to you. Never buy life insurance as an investment. And then number three, Never rely solely on life insurance provided by your employer. Guys, if you tell your friendship group those things, they're going to say, I need to talk to you because I'm guilty of one, two, or all three of them. I'm guilty of these. I need to talk to you more about this. Set up a time to meet with them. The three nevers when it comes to life insurance. Teammates, we got a lot of work. April, talk to me. You got a question?
Why is the Gerber whole life policy so popular? I mean, I bought that too.
Because they put the black couple on the commercial. No, I'm joking. Because Gerber is a trusted brand.
Mm-hmm.
And so, oh, Gerber, they got a life insurance policy. They must be doing right. But they're selling whole life policies. And they're trying to make money just like everybody else.
So how are we to educate those young parents, you know, people like how I was caught in it? I mean, obviously I did it the very next year that Kendall was born, you know, so how do you, I mean, you encourage them not to get that and just get something else on their child or just do a ride? Well, you can't do it. You could do a rider on the term. Absolutely.
When the parent gets their own personal life insurance policy, their child could be a rider on their policy.
Okay.
One thing, teammates, and Auntie, I'm coming to you. And Rahima made a great comment. Rahima put in the chat, she said, the reason why people buy those policies is because it's cheap, it's a familiar name, and it's marketed for protecting kids and for kids' education. And so people are thinking that that's what they're doing. But I promise you guys, these little Gerber plans that's touting that they can help pay for your kids' college education, if you look in the cash value table, by the time the kid turn 18, they're going to have about $2,000 in there. But people go in there thinking that it's going to be enough for the tuition to pay the college. I'm like, no. You're only paying $8.03 a month. Like, it ain't no magic wand that's going to increase that like that. But Auntie, you got a comment?
Yes, thank you. Great training. I just wanted to share. I met with a young lady who started a new job. I think she was with this. No, I don't know if it was the state, but she was in her late 20s. And she wanted me to review the information that her job gave her. And I showed her in the terms from the job that if she was out sick 3 days, she was going to lose the life insurance. And she was like, what? So job insurance is absolutely not guaranteed. And her terms clearly said if she wasn't in the workplace for 3 days and she was out sick, she was going to lose her life insurance with the company.
Oh, Jesus.
Exactly. I just wanted to share that.
What's so interesting, just to piggyback on what Auntie said, people trying to hide behind their job insurance, they don't even get a policy, y'all. They don't even get a policy. Let me ask you something for all the homeowners out there. If you closed on your house and you know what it was to close on your house, they gave you them big stack of documents, Coach B. What if you closed on your house, they never gave you a copy of your closing documents? What if they never get, and they just said, hey, Benicia, just pay this mortgage. You have no proof that this is your, but pay this mortgage every month on this day and stuff like that, and you'll be straight. Now, we're not going to give you no documents, but just pay that mortgage every month. You don't know what the terms of your mortgage is. What if somebody showed up at your house and said, this is my house? See, I got the paperwork that says that this is mine. See, they never give you a policy. So you can't even refer back to it and even see what it says. So people feel they will literally rest their livelihood, Selena, on if I die, this policy gonna take care of my family because they deduct $12 out of my paycheck every 2 weeks. But they don't have any proof. That's the reality that we're dealing with, and we got to connect that dot for our people. If the job insurance was paying out so good, y'all, why are there so many GoFundMe's? Think about it. Think about it. What's the chat saying? Okay, yeah, y'all got Selena's question. Good deal. So the child would be a rider on the policy until they turn age 25. And then they're able to get their own policy and all that good stuff. And so that's what we would recommend. And if a person is concerned about investing money for the college, then what we do is we do a college plan for the person, for their child. We have 529 education plans, or they can just do a mutual fund, whatever they want to do for the kid, they can invest money for the child. And so we can do those things. All right. But guys, we got a lot of work to do. Next week, we'll talk about universal life, because universal life, it works a little bit different. Similar, but different. So you want to come back next week for the universal life breakdown. Are y'all with me on that? Coach B. Wall, comments. Talk to us.
No, I was just thinking, okay, I was pausing. The universal life, I'm actually dealing with that right now with a client. So make sure y'all show up next week, because understanding the differences between how whole life works versus universal life, y'all, you want to show up for this. This was a great training, Nick. Miss Jackie just talked about the policies on the job. I know some of y'all probably heard me tell y'all the story last year, but I know it's a lot of people on the call. Y'all, don't let people sit in front of you and tell you, hey, I have life insurance on the job, I'm good, I'm fine. I saw Virginia put in there that the job owns the policy. I wouldn't be happy as a homeowner. And I didn't get my documents. Trust me, when I was sitting at that table, I was ready for all my documents to leave with me, and I made sure I read all those. But what I want to say is, I met with a young man back in 2020 during the pandemic. Okay, I had an agent on my team, my cousin's friend. Okay, from my hometown. This young man had 4 kids, banked on the job, y'all, for a long time. We met with him more than one time. Okay. Fast forward, last year, I think October, he had a motorcycle accident and passed away. And has his 4 kids. His mom was the beneficiary. You guys, first of all, they had to do fundraisers to pay for the funeral, right? And the mom received a check for $6.43. Okay. What is $6.43? See, Selena, your reaction. Imagine my reaction, okay, when I found that out. And the only reason I found out the details of it is the fact that another agent on my team is best friends with the sister, okay? And so I was able to find that out. But the fact that, y'all, it's a lot of people who bank on the job insurance. Oh, I'm fine. I have insurance on my job. I'm fine. But you have 4 kids. You have a whole family. You have a wife. You have a husband. Listen, y'all, we have to make sure that we are talking to them. But if we don't listen to the stories that people are telling us on these calls, then you're not going to be able to use an example. So you can use as an example, listen, because it's true. This truly did happen, and so those 4 kids, the mother's going to have to figure out how to get them to 18. And the youngest child was like 3 years old. Okay. So that is very unfortunate when I hear stories about like that, but especially when I had an opportunity to meet with this young man. I know him. I know his whole family. I know his sister. I went to school with his sister. But to be able to sit in front of him and I'm telling him all these things, about the job insurance. He didn't want to hear it. He didn't want to listen to me. Y'all, $6.43. That is so unfortunate. Okay. And so next week, just like we were talking about whole life today, it's so many people out here that feel like they're going to get both the cash value and the face value of the policy, y'all. Understand how buy term invest the difference works. You need to be able to sit in front of people, explain it. Just like Nick showed us tonight. Nick, I'm glad that you did this training. Universal life, y'all. If there are things that you don't understand, and I love the fact now I use Chat GPT now, y'all. Okay, I use it now. I study everything I need to, but I think that if there's some things that you still have questions about, especially when it comes to universal life, what I did today was I talked to a client who's trying to switch over. He's not trying. He's fine now. Okay, so he was entertaining the whole concept of universal life, and I don't want to really talk too much about it, but he sent me the policy quote. All I did was I click, put it in Chat GPT, and it said everything that I needed to say, and I did it like that because I knew what I was gonna say, right? But sometimes people, and I've been knowing him since college, so you know I can explain it to him in detail. But sometimes people want to know a little more, right? So you back it up. And I'm saying that because it will help all the new people, all the new licensed people to understand things a little more in detail when it comes to universal life, because that is so popular, y'all. It's going to tell you exactly what you're being taught, what Nick is going to talk about next week, but it's going to help you to see it and understand it a little more, and then be able to break it down to people that you personally know, because y'all, they're out here. They are out here trying to get your people. This is for all the old people. They are trying to get your people, and for all the new people, y'all need to make sure y'all are protecting the your family and friends from getting on board with buying these type of policies. Okay, so Nick, great training, love it. I'm sitting over here, yeah, you know, because I know every single thing you're sitting up there talking about. I'm like, yeah, because we need to know this, and people are really being sold this. You know, my mother was sold a whole life policy, and I talked about my biological father passing when she was pregnant with me. 4 kids, y'all. Come on now. Whole life policy, $10,000 does not do anything for anyone. Okay. So let's make sure we're setting our clients up for success and getting in front of them and pulling them out of those policies that are not going to benefit them. All right.
I love it. Guys, we're doing the right thing 100% of the time. So go ahead and get it in your spirit that you are a life insurance crusader. You are a financial independence crusader. You are a generational wealth crusader. And knowing your craft and knowing what's out there and how to speak out the truth about it will help you. All right. And so we're going to go ahead and stop it right about there.